Hello everyone and welcome back to my channel. Today in this video we'll take financial instrument chapter for MCQ discussion. Are you ready? But before we start, if you are new to this channel, don't forget to subscribe this channel. And if you are watching this video and you are getting some benefit, don't forget to press the like button and share this video with your friend. Can we start? Yes sir. So let us start with the question number 1. I hope already you have downloaded this MCQ PDF from my Telegram channel. If you have not downloaded, then go to my Telegram channel. The link of the Telegram channel is given in the description of this video. And from that Telegram channel, you can download this PDF. Got this point? Yes sir. Come to question number 1. So Indian accounting standard relevant for recognition, measurement, disclosure of financial instrument are, so there are 3 Ind AS, Ind AS 32, Ind AS 109, Ind AS 107. So all of the above is correct. Okay sir. Question number 2, financial asset are cash, correct. An equity instrument of another entity, this is also correct. And a contractual right to receive cash or any other financial asset from another entity, this is also correct. So all of the above is correct. Chalega. Come to question number 3. Ind AS 109 financial instrument classified a financial asset and financial liability into following category for recognition and measurement. So measure at FBTOCI, measure at amortized cost, measure at fair value through PL. So of course, can I say financial asset are categorized in all the category, but financial liability we have 2 category, FBTPL and amortized cost. So you can say all of the above. The best option is all of the above. Question number 4. Ind AS 109 deals with recognition and measurement of financial instrument and hedge accounting, correct. Presentation of financial instrument, correct. Disclosure of financial instrument, correct. Means Ind AS 109, if you see, Ind AS 109 deals with the recognition and measurement. It does not deals with the presentation, because for that Ind AS 32 we have. And for disclosure we have Ind AS 107. So option number A will be correct. Got this point? Yes sir. Question number 5. And is any contract that evidence a residual interest in the asset of the entity after deducting all the liability. This is equity instrument. So option number A is correct. So an equity instrument is a contract that provide residual interest in the asset of the company after deducting all liability. Question number 6. Ayushman Limited investment in Dinka Limited does not provide Ayushman Limited sole control, joint control or significant influence. Means they do not have control, joint control and significant influence. The investment was purchased on 1st July 2002 for rupees 15 million. The cost price was 15 million. The investment was classified to FBTOCI. Okay. The fair value of investment Dinka Limited on 31st March 2003 is 60 million. In the tax jurisdiction in which Ayushman Limited is located, unrealized profit of revaluation of equity instrument is not subject to current tax. Means it is not taxable for current tax. Any such profit are taxed only when the investment is sold. What would be the increase in the value of investment Dinka Limited during the period financial year 2002-2003 to be shown in other comprehensive income? Correct. So you can see there is a gain of how much? There is a gain of 1 million. The gain of 1 million, 60 million minus 50 million. But can I say it will be transferred to OCI? And OCI is transferred net of related tax expense. So can I say in this we need to create a deferred tax liability. Means this will result in a taxable temporary difference. Why? Because in this case, can I say the carrying amount is how much? 60 million and the tax base will be 50 million. Therefore, there is a taxable temporary difference for which we need to create a deferred tax liability. And deferred tax liability will be created through OCI. So 1 million into the tax rate is not given. So tax rate is not given. Actually, the tax rate was missing here. So you can write on यहाँ पर somewhere कि tax rate is equal to 20%. Tax rate is equal to 20%. In exam, the tax rate will be given. Don't worry. So into 20%, so that it will be 0.20. Therefore, in OCI will transfer by 0.80. So option number A is correct. Option number A is correct. Okay, sir. Yes, sir. So can I say it become 80%? 80% become 0.80. Got this point? Option A is correct. Chalega? Yes, sir. Good question. Question number 7. Based on approval of Board of Directors on 1st April 2002, Ayushman Limited issued 15 million bonds of rupees 1 each at par. So they have issued 15 million bonds. The annual interest payable of this bond is 5% per annum. So this is a contractual rate of interest payable in arrear. Payable in arrear means at the end of the year. The bonds are redeemable at par on 31st March 2007. Means after how many years? 3, 4, 5, 6, 7, 5 years. Or convertible at the option of the bondholder. It is convertible, optionally convertible into equity share as on the date. On 1st April 2002, the investor of bond with no conversion option would require an annual rate of interest is 8%. So this become market rate of interest of similar bond without conversion option. On 1st April 2002, the directors of Ayushman Limited included 50 million in long-term borrowing in respect of the bond, and actual interest paid is 2.5 million charged to as a finance cost in Ayushman Limited income statement. This is not correct because can I say we need to, because this is a compound finance instrument, it is split into liability and equity component. Then interest expense will be calculated on financial liability, means liability component, by using EIR. Correct. So relevant, you can see the relevant discount factor is given for 5%, 8%. This is not relevant because we'll do discounting at market rate of interest. Calculate a finance cost to be charged to statement of PL for 50 million bond issued on 1st April 2002. We need to first find out the liability component. So liability component will be how much? You can see the interest become 50 million into what? Contractual rate of interest is what? 5%. It will become 2.5. So 2.5, the present value factor is given. So present value annuity factor they have given 3.99. To multiply by 3.99. So 2.5 into 3.99 is equal to how much? 9.975. And it is redeemable because it is optionally convertible. Therefore principal amount will be classified as financial liability, and the redemption value is at par. So 50 million multiplied by a minute 50 million multiplied by 68.1 paise, so it will become 0.681. So 50 into 0.681 is equal to what? 34 point, coming how much? 34.05. So total become plus 9.975 is equal to 44.025. This become the liability component. On this will calculate interest by using EIR because there is no transaction cost. EIR will be equal to market rate of interest, therefore 8%. So into 8% is equal to 3.522. So option number B is correct. Option number B will be correct. Got this point? Now come to question number 8, everyone. On 31st March 2018, A Limited has given loan to B Limited with low credit standing but still at an acceptable level for A Limited. What loss allowance will be recognized by A Limited in its financial statement in relation to loan given to B Limited? Now it is a financial asset, they are asking about impairment loss. In this case, the credit risk has not increased since initial recognition. And whenever credit risk has not increased since initial recognition, then we are into first stage of impairment. So first stage we always measure at 12-month issue. However, in second stage, third stage, if you remember, we measure at lifetime issue. So in this case, because we are into first stage, the option number B will be correct. Means either it will be or C. First stage B, second and third it will be what? C. Got this point? Good question. Option number B will be correct. Come to question number 9. A Limited has accepted rupees 10 crore share application money from PQR Limited shares which will be issued to PQR based on the future market value. So can you say it will be issued to PQR Limited based on future market value? Means right now the number of shares is not fixed, and whenever number of shares is not fixed, then F2F means fixed to fixed test will not be satisfied. Therefore, it will not be classified as equity. It will be classified as financial liability. So how A Limited should classify the share application money received from PQR Limited? So of course option number A and option B is not correct. Either it will be financial liability to measure at cost or financial liability to measure at fair value. Because can you see it is equity shares, so it will measure at fair value. Correct? Because there is no contractual cash outflow in this case. Correct? So financial liability to measure at fair value. Option number D will be correct. Got this point? Yes, sir. Good question. I will say question 9 is good question. Come to question number 10. ABC Limited factored rupees 2 million of its trade receivable to a bank during the year. Factored means they have transferred the receivable. The bank paid rupees 1.8 million to ABC Limited. Bank charged ABC Limited rupees 1 lakh fee for this. So 1 lakh fee has been charged. All responsibility receivable will be returned to ABC Limited, means risk and reward has not been transferred. And whenever risk and reward is not transferred, the debt means financial asset cannot be de-recognized. It will remain in the balance sheet of what? The company only. If the debt left unpaid after 6 months. Correct? So in this case, can I say the 2 million will not be de-recognized and they need to recognize the consideration received as liability. So liability will become 1.8 million, but bank charge ABC Limited rupees 1 lakh for this. So this 1 lakh become a transaction cost, therefore financial liability measured at 1.8 million minus what 1 lakh. So it will be what? Let's see. So 1.8 million shall be considered as loan and accounted as financial liability. This is correct. One is correct. 1 lakh should be deducted as transaction cost for financial liability. This is also correct. And loss of 2 lakhs should be recorded. This is not correct. The receivables should be de-recognized. This is also not correct. So which one is correct? 1 and 2 is correct. Option number A is correct. You can see option number A is correct. Good question. Come to question 11. ABC Limited has borrowed a loan from bank which has a prepayment penalty to compensate the bank for any pre-closure of the loan. State which of the following is correct with respect to the embedded derivative. Now can you say when we have taken loan with prepayment option, so there is some embedded derivative. But this embedded derivative are actually closely related with the loan and therefore separation is not required. What our India says that whenever embedded derivative are closely related to the host contract, then separation is not required. So what they have said, embedded derivative is closely related to loan, so this is correct. Embedded derivative is not closely, this is not correct. Embedded derivative is an insurance contract, this is also not correct. There is no embedded derivative, this is also not correct. So embedded derivative is closely related to the loan and therefore separation is not required, because hence no bifurcation is required. Good question. Come to question 12. ABC Limited has invested in debt-oriented mutual fund. Debt-oriented mutual fund means this debt instrument mutual fund. The investment should be subsequently measured under IFRS 9. This is not IFRS 9. This will be Ind AS 109. Ind AS 109 as. So this is a debt instrument where contractual cash flow condition will not be satisfied, because when we have invested in mutual fund, so actually mutual fund will get the entire amount only when we have sold, means when we have realized that amount. So there is no contractual cash flow characteristics, and whenever contractual cash flow characteristic is not satisfied, then it will measure at FBTPL. So it will measure at FBTPL. Option number B will be correct. Option number B will be correct. Question number 12 you understood? Good question. Chalo. Let us do question number 13. QA Limited issued 10 lakh of 8% long-term bond A series of rupees 1 each on 1st April 2016. The bond tenure is 3 years. So 3 years the tenure, interest is payable annually on 1st April each year. So interest is payable annually on 1st April. It does not mean it is payable at the beginning. Just try to understand, whenever they say it is payable at the beginning of, it is payable on 1st April, it means what? Normally it is payable at the end. And at the end means 31st March. So 31st March become the end of the first year. But when they say it is payable at the beginning, so at the beginning of not current year, at the beginning of second year. So at the beginning of second year or the end of first year is same only. So whenever they are saying interest payable annually on 1st April, don't think that interest payable at the beginning of current year, first year. Got this point? So here students are confused. So whenever they say interest payable annually on 1st April each year, means it is not payable at the end of the first year, it is payable from the beginning of second year. Got this point? So at the end of the first year and beginning of second year, both are same for discounting. The investor expect an effective interest rate on the loan at 10%. Now they have given effective rate of interest. So 8% is the contractual rate of interest and effective rate of interest is 10%. Means, can I say, whenever there is effective rate of interest, means there is some transaction cost. Means there is some transaction cost paid. QA Limited want to suggest the suitable accounting entries for the issue of these bonds as per the applicable Ind AS. Consider a discounting factor 3-year 10% discounting factor and 3-year cumulative discounting factor is given. So this is present value factor and this is present value annuity factor. What is the principal value of bond at initial recognition at a time of issue of bond as per the applicable Ind AS? Give reasoning. Reasoning is not required in FR exam. Don't worry. So principal value will what? 10 lakh is payable at par. So 10 lakh multiplied by 0.751315 is equal to 7,51,315. This is the answer. Option number C is correct. What is the present value of interest payment? So interest was 10 lakh ka 8%, that is 80,000. 80,000 multiplied by annuity factor. Annuity factor given how much? Is 2.48. 2.4868685. So that will be equal to how much it is coming? 80,000 into 2.48685. That is equal to 1,98,948. Means option number C is correct. What are the proceeds of the sale of the bond to be recognized at the time of initial recognition? That will be this plus this. So plus ka to 7,51,315, that is equal to 9,50,263. Option number B is correct. Now it means just try to understand. 10 lakh was the transaction price received, and the minus what? It is 9,50,263. So this is coming how much? Minus 10 lakh. So it means 49,737 is what? Transaction cost. Transaction cost, or we can assume that these debentures or bonds were issued at discount. This can be possible assumption. Means what is the initial journal entry normally we do? So normally the initial journal entry what? How much we have received bank account? Debit. How much? 9,50,263. To what? Financial liability. 9,50,263. Either you can say it is nothing but fair value minus transaction cost, or you can say it is issued a discount, so 10 lakh minus this is a discount. So normally we pass this journal entry. Got this point? Or we can pass one more journal entry, bank account. Bank account 9,50,000. Discount account debit or transaction cost account debit to financial liability 10 lakh. Normally we don't pass that type of journal entry. Correct now. But if you see option number B, you will be confused. If you see point number 4, you will be confused. What is the accounting entry to pass at a time of accounting for the payment of interest? So interest will be calculated on 9,50,263, means 10% is 95026. So you can see the option number B will be correct. But what journal entry they have given? They have given interest expense account debit to bank. So interest expense is what? 95,026, and to bank is 80,000. And difference normally we adjust with financial liability, but they have adjusted with discount bond. So if you have debited discount, then only credit discount. So taking that journal entry into consideration initial recognition, this can be one possible journal entry. So you need to, in exam you need to be thoda sa smart to understand the journal entry. So option number B will be correct. Option number B will be correct. So thoda sa be careful about this journal entry. Got this point? But I am not happy with this option. It should be interest expense account debit to cash or bank, and the difference will be adjusted with financial liability. Chalega? Yes, sir. This is also done. Come to question number 14. On 1st April 2016, K Limited purchased an equity instrument in entity Y for rupees 120 lakh. So they purchased an equity investment. The investment did not give K Limited control or significant influence over the entity Y, but the investment is seen as a long term. Okay. K Limited planned to hold the investment till 31st March 2019. Did they want to hold the investment? On 31st March 2017, the fair value of K Limited investment equity was estimated to be 130 lakh. So 120 become 130. Market rate of interest is 10%. What will be the investment amount outstanding as on 31st March 2007? So can I say it will be measured at either at FBTPL or FBTOCI, because it is an equity investment. So measurement will be at fair value, either FBTPL or FBTOCI. So answer will be option number A only. This interest rate is of not at all relevant, because for equity investment there is no interest payment. Got this point? So this is actually not relevant. Market rate of interest is not relevant, so be careful. So answer will be 130 lakh. Good question. I will say good question from examination point. You will be confused with the market rate of interest given. Question 15. On 1st April 2016, K Limited gave a 3-year loan of 100 lakh to entity X. So K Limited has given a loan. The market rate of return is 10% per annum. On 31st March 2019, the K Limited received a fixed number of shares in entity X in full settlement of the loan. So K Limited received a fixed number of shares of entity X in full settlement loan. Entity X paid the interest due of rupees 8 lakh on 31st March 2017. Entity has no liquidity problem. Following the payment of interest, the fair value loan asset at 31st March 2017 was estimated to be 105 lakh. As on 31st March 2017, the loan will stand at what amount? So you can see this loan is a financial asset in the books of K Limited, because K Limited has given loan and the market rate of interest is 10% per annum. However, this loan will be settled in the fixed number of entities' own equity shares. So this will be settled, means on 31st March 2019, K Limited receive a fixed number of shares in entity X Limited. So this will be settled in equity shares. So this become equity. Actually, if you think from entity X point of view, this become equity instrument of X Limited, because that will be classified as equity in the books of entity X. Chalega. So can you see this become equity instrument of K Limited? So any equity instrument of K Limited will be measured at FBTPL or FBTOCI. So as on 31st March 2017, can you say the amount, the loan will stand at fair value, and the fair value will be how much? It will be, what is the fair value given? 105 lakh. So 105 lakh is the answer. Good question, I will say it is a good question. Correct. You will be confused. It is a very good question. So just try to understand what they want to say. K Limited has given a 3-year loan to entity X, and this will be settled in entity X own equity shares, which is fixed number. Now from entity X point of view, it is equity instrument, because fixed to fixed test will be satisfied, F to F test will be satisfied. So it will be settled in fixed number of entities own equity shares. So it become an equity instrument of entity X. So any equity instrument of other entity will be what? Financial asset, and that will be measured either at FBTPL or FBTOCI. Correct. So in this case, it will measure fair value, and fair value become what? 105 lakh, and therefore on 31st March 2017, the value will be 105 lakh. Got this point? Come to question 16. On 1st April 2016, K Limited made an interest-free loan to an employee of 8 lakh. The loan is due for repayment on 31st March 2018, and the K Limited is confident an employee will repay the loan. K Limited normally require an annual rate of return of 10% on the loan. What amount of loans should be shown as on 31st March 2017? So it is an interest-free loan, correct? And the market rate of interest means, you can see what they have given. The K Limited normally require annual rate of return at 10%. This become market rate of interest. So what will be the amount as on 31st March 2017? It will be 8 lakh. Correct? Understood? So as on 31st March 2017, this is what? A concessional loan. So first we need to find out the fair value of loan. Fair value of loan will be how much? We need to, this 8 lakh has been given for how many years? K Limited, and due for repayment on 31st March 2018 means 2 years. We'll first find out the present value, means fair value of this loan, for means we need to find out present value of contractual cash inflow discounted and market rate of interest. So 1.10 divide equal to we will do 0.826. This is coming how much into 8 lakh, that is coming 6 lakh 61,000, 6,61,157. This become the fair value of financial asset. Now we'll do calculate amortized cost. So we'll first find out interest income on this on at a rate of 10%. That become into 10% is equal to how much? 66,115, and the contractual cash inflow is 0. Therefore it will be how much, batao? It will be 7,27,273. This is the answer. The option number D is correct. This is also very good question. Means you will be confused in exam. Question number 16 is also good question for MCQ based. Yes, sir. Come to question 17. When a financial instrument is reclassified, the effect of such reclassification should be recognized by the entity. Select the correct answer from the below mentioned option in respect of accounting of such reclassification. So reclassification is normally done on prospective basis. Let's see. Accounting for reclassification should be done on retrospectively basis. A is wrong. Accounting of the reclassification should be done prospectively from a date on which entity decided to reclassify the instrument. This option number B is correct, but read C and D also. Accounting of such reclassification should be done with the effect from first day of reporting period. This is not correct. Accounting of reclassification should be done prospectively only if it is impracticable to account for such changes retrospectively. This is also not correct. Option number B is correct. Good question. Chalega. Question 19. Which of the following statement regarding the reclassification of financial statement is correct? Once again, reclassification wala point. Reclassification is important for MCQ. Reclassification of financial asset and financial liability is required, but reclassification of only financial asset is permitted. There is no reclassification of financial liability permitted. So option number A is not correct. Reclassification of financial asset required when the entity changes its business model for managing the financial asset. This is correct. Only when business model changes, we reclassify the debt instrument from one category to another category. Financial liability are not permitted to be reclassified. Option number B is only correct, but read C and D also. Reclassification of financial asset and financial liability permitted, not correct. Reclassification of financial asset and financial permitted when? This is also not correct, because financial liability reclassification not permitted only. Good question. Chalega. Come to question 19. Which of the following is correct methodology to separate liability and equity component of a compound financial instrument? So what we do whenever we find out liability and equity component from a compound financial instrument, we deduct from proceed fair value of liability component and the residual amount become fair value of equity component. Calculate a fair value equity and liability component based on their respective fair value. This is not correct, because we only calculate fair value of liability component. Calculate a fair value of equity and liability component based on their, this is also not correct. Calculate a fair value liability component on initial recognition and allocate the residual value to equity component. This is correct. Option number C is correct. So sometimes we know the concept, but with options will be confused. Be specific about the options. Chalega. 19 understood. Now come to question number 20. Good question. Therefore I have highlighted this. Okay, sir. So an entity issue a non-redeemable bond. Non-redeemable means irredeemable with a call option. With a call option means there is a right to buy with entity. Means entity have a right to buy. Correct? Means the option to redeem is not with the holder. Where the fixed dividend of 5% can be deferred at the issuer option, and can I say it is irredeemable with a call option means repayment right is with what? Entity, and that there is a fixed dividend which can be also deferred by entity. Correct? There is an economic compulsion for the issuer to pay dividend. There is an economic compulsion. Normally what happen, even though we have a right to defer the dividend payment, but there can be economic compulsion. Economic compulsion means for the reputation of the company we should pay the dividend, but this does not mean that they do not have right to defer it. Got this point? So can you see in this case, because there is no obligation to pay principal amount as well as there is no obligation to pay the dividend amount, therefore it will be classified as equity instrument. Correct? Good question. What is the classification of bond? So it will be equity instrument. Option number C is correct. Option number C is correct. Chalega? Yes, sir. Come to question 21. Suppose the company has issued preference shares that are redeemable at the option of holder, means it is classified as financial liability 3 months before the end of the year. It was probable that holder would require redemption. Which one of the following is the appropriate classification of annual payment of 12,000 preference to preference holders? So whatever dividend we are paying, that will be recognized as an expense. So dividend rupees 12,000, interest expense of rupees 12,000, dividend of 3,000, dividend of, this is so not correct. So interest expense of 12,000 means it can be either dividend expense or it can be either interest expense. Okay, when we say only dividend, it means it is a dividend distribution. Got this point? So it should be an expense. So option number B is correct. Option number B is correct. Okay, sir. Question 22. Flywing Airways Limited delivered a quantity of aircraft component to a customer on 31st December 2018. The invoice amount is rupees 5 lakh. The company expected to receive a payment on 28 Feb 2019. The company expected to receive the payment on 28 Feb. However, no cash was received till 31st March 2019, but no cash was received. On 30th April 2019, the credit control department informed that customer has major cash flow problem as a result of failure of one of the project sometime in Feb 2019. Means the indicator impairment. They have agreed to allow the customer to settle the debt until 31st March 2020. So now the settlement is that it will be paid, it will be settled after 1 year. Correct? Now after 1 year means 31st March 2020, by which time the customer is confident that cash flow problem will be resolved. So Flyways Airways Limited currently expected that annual interest rate of 6%, that is effective interest rate, can be received against any money lent out, yet it allowed a customer an interest-free payment period. Means even though interest-free period is there, but then also there can be, there will be some interest component. So what India's 109 says that if there is an indicator of impairment, we need to find out expected credit loss, and expected credit loss will be what? The will be we need to find out impairment loss, which will be the difference between the amount which is receivable minus, can I say, the present value of the amount, present value of expected amount which can be received discounted by original year. Correct? So in this case, first we'll find out how much receivable? 5 lakh is receivable after 1 year. So 5 lakh into, what is the discount rate? Discount rate was 6%. We will do 1.06 divide equal to, that is into 0.943 into 5 lakh is equal to how much? 4,71,698 minus 5 lakh is the carrying amount. So impairment loss will be 28,301. So impairment loss will be 28,301. What they have asked, let's see which Ind AS are applicable for the accounting treatment. So in this, the Ind AS is applicable is 109, and of course can I say, because the indicator was indicator, you can see they have agreed to allow the customer to settle their debt. Means if you, in this case on 30th April, the credit control department informed, means this is after balance sheet date. So before approval of financial statement, so there are two Ind AS. One is Ind AS 109 and one is Ind AS 10. One is Ind AS 109 and one is Ind AS 10. Chalega, the option number D is correct. Then calculate the closing balance. Already we calculated 4,71,698. The closing balance is 4,71,698, and the difference will be impairment loss. The difference between 5 lakh and this will be impairment loss. Chalega, if they ask that also. Let me come to question 23. Need Cash Limited is looking to raise fund using various methods, but it is also concerned that some item may impact the income statement. Your advice is required on which of the following item will impact statement of PL. So dividend payment of preference shares that are classified as financial liability will impact what? SOPL. Incremental directly attributable cost incurred in successfully issuing a bond. So this transaction cost of a financial liability will be also affecting SOPL. Correct now, will be a big by way of effective interest rate. Interest payment of bond, this will also affect SOPL. Dividend payment of share classified as wholly as equity, this will not impact because this is on equity. Incremental directly attributable cost incurred in successfully issuing equity share, this will also not affect SOPL. So SOPL will be affected by A, B, C. So option number A is correct. Option number A will be correct. 23 also done. Now 24. QA Limited has also issued 10 lakh of 8% long-term bond B series of rupees 1 each on 1st April 2016. The bond tenure is 3 years. Interest payable annually on 1st April each year. However, the bond holder of the series are entitled to convert a bond to share of rupees 1 each on the date of maturity instead of receiving the principal repayment. Means this become a optionally convertible bond. Correct now. However, similar question we have done, but that question was not optionally convertible. Got this point? Interest rate on similar bond without conversion option is 10%. This become what? Market rate of interest. QA Limited has requested to suggest the following for this type of instrument. What is the entry to be passed at the time of issue of the bond as per applicable Ind AS? So we need to find out the liability component, equity component. This 10 lakh, it will be convertible. It may be converted into equity share because it optionally will be classified as financial liability. We need to find out the discounting factor for 3 years. At what rate? At market rate of interest 1.10. So divide for 3 years. It will become 0 into 0.7, means multiply kar do, into 10 lakh is equal to how much? It is coming 7,51,314. Got this point? And then interest component will be, interest payment is 10 lakh ka 8% ka 10 lakh ka 8%, that is what? 80,000. So 80,000 into, you need to find out annuity factor for 3 years. It is 1.10 divide equal to, it is 0.90909, then equal to 0.8264, then 0.75131. Correct now. Plus कर दो 0.82644 plus 0.90909 is equal to 2.48 something is coming, that is into 80,000. That is coming how much? 1,98,947 plus what? 751,314. It is coming around 9,50,261. Now I have taken 5-6 decimal because I know the answer is given at 9,50,000. If you will take 3 decimal, it will come around 9,40 some change. Then also your answer will be correct. You need to find out the approximate answer. Got this point? So in this case, 9,50,261 means this answer is correct. So of course the journal entry will be bank account debit to financial liability to equity instrument. Equity instrument is nothing but share option account. You can write down. So option number B is correct. What is the entry to pass at a time of conversion? So when it will be converted into equity shares, then can I say then the liability will become 10 lakh. The liability will become 10 lakh. So it will be 10 lakh. And share option account is 49,737. It will remain unchanged. So this option number B is correct. 10 lakh 49,737. It will be transferred to equity share capital, and the balance will be transferred to equity securities premium. So option number B will be correct. Got this point? Yes, sir. Easy. Come to question 25. On 1st April 2018, Apricot Limited has two equity instruments that it designate as FBTOCI in accordance with Ind AS 109. As the date of acquisition name, it is Daimler Limited and EcoStar Limited. Original cost, fair value as on 31st March 2018 and fair value as on 31st March 2019 they have given. On 31st Jan 2019, is before year end, Apricot Limited disposed of its investment in Daimler Limited for rupees 19,500. For rupees 19,500. Okay. So, okay. It was sold at 19,500 to 19,500, and the opening amount is what, 15,000. So there is a gain of how much? 19,500 minus 15,000 is equal to what? 4,500. Okay. And sold a profit on sale as a part of investment income. Apart from recording the receipt of dividend income, no other entry have been made in the financial statement for the year ended 31st March 2019 regarding the investment in EcoStar Limited. Both investment has been correctly treated as in the financial statement so far. Okay. Calculate the amount which should be shown in OCI. So can you say any gain or loss of equity instrument which has been transferred to FBTOCI will be also transferred to OCI only and accumulated in FBOC reserve. This will be transferred to OCI. And can you say in this case you can see the initial opening balance was 14,000. Now it become 15,400. So there is a fair value gain of 1,400. So total become how much? 4,500 plus 1,400 is equal to what? 5,900. So answer will be what? 5,900. Option number D will be correct. Option number D will be correct. Chalega? Yes, a good question. Means for admittable question, normally they may ask MCQ question in exam. 26. Some of the main bank customer are in trouble times and they are going through strategic debt restructuring, that is renegotiating with the main bank the terms of the debt. Can I say it is nothing but modification of financial liability. Help them understand the requirement of Ind AS 109 so they can access the accounting implication for the loan in their bank. A qualitative assessment is sufficient as the counterparty for the modified loan is the same as before. Let me read all the options. Although the counterparty is the same, since the two loans are considered as separate financial instruments, the old loan must be mandatorily de-recognized and the renegotiated loan has to be recognized. Means this is not correct because if you remember, there are two type of accounting: extinguishment accounting and modification accounting, which depends upon the substantial modification terms. Correct now. A qualitative assessment may not be sufficient and a quantitative assessment may be required. If there is a substantial modification, the old loan need not to be recognized. This is also not correct because whenever substantial modification is there, old loan will be de-recognized. A qualitative and quantitative assessment may be needed. If there is a substantial modification, the old loan must be de-recognized and the renegotiated loan has to be recognized. This option number D is correct because in that case, if you remember, whenever modified terms are substantially different, then we follow extinguishment accounting. In that case, we de-recognize the existing liability and we recognize the new liability at fair value. So option number D is correct. Got this point? I think correct. 26. Good question. 27. ABC Limited purchased 10,000 shares on 1st April 2016, making the election to use the alternative treatment under Ind AS 109, that is FBTOCI. The shares cost rupees 3.5 each. So 3.5 is to 10,000 into 3.5. How much it become? 10,000 into 3.5 is equal to what? 35,000. Okay, sir. The transaction cost associated with the purchase 500. 500 will be added. It will become 35,500. And at 31st March 2017, the shares are trading at 4.50, which become 45,000. What is the gain to be recognized on the share? The gain will be how much? 45,000 minus 45,000 minus 35,500. So gain become 9,500. So gain become 9,500. That will be transferred to OCI. So 27. Good question, I will say. 9,500. Okay, sir. Easy but. Come to question 28. On 1st April 2018, Apricot Limited issued 3 lakh loan notes of rupees 1 per note at par. The loan notes entitle the holder to an interest payment of 5 paise per note, payable annually in arrears. It is 5 paise per note. Okay, sir? Correct. The loan notes are repayable at par on 31st March 2023. Means after how many years? 18, 19, 20, 21, 22, 25 years. As an alternative to repayment, the holder can elect to convert the notes into equity shares in Apricot Limited. So it is actually optionally convertible. On 1st April 2018, the investor in non-convertible note expect an annual return of 8%. Market rate of interest, you are given the following discount factor. So you can see they have given discount factor at a rate of 5%. This is not relevant. At the 8%, this is relevant. On 1st April 2018, the directors of Apricot Limited recorded loan liability of 3 lakh and a finance cost of 15,000, which is not correct. In respect, calculate a finance cost of the convertible loan. So first we need to find a financial liability. So financial liability will be how much? 3 lakh into what you will do? You will do the 8% is 0.681. So it become how much? 3 lakh into 0.681 is equal to how much? 2,04,300. And then the interest is 5 paise means 15,000. 15,000 will do cumulative annuity factor. That is what? 3.999. So 3.99 you will do. So 15,000 into 3.99 is equal to how much? 59,850. The total become how much? 2,04,300. That is what? 2,64,150. Now for this we will find out interest. Interest will be at 8%. So multiplied by 8%, how much? It is 21132. So option number A is correct. Option number A will be correct. Good question. Means for MCQ, these are very easy question, but you can do calculation mistake or you may take more time. So you should be very much fast in the calculation. That is fine. Question 29, on conversion of convertible instrument at maturity, the entity de-recognize the liability component and recognize it as, of course, equity. So on conversion of convertible instrument, they will de-recognize the liability and recognize it as equity. Option number C is correct. 30. The middle office of Main Bank Limited is examining the financial statement of its customer in order to ensure the loan covenant are being met, especially with respect to debt equity ratio. Assist them in determine which of the instrument will be qualify as equity in the entirety. So we need to find out which will be equity in its entirety. Redeemable debenture with discretionary dividend is a compound financial instrument. Redeemable and discretionary. Optionally convertible redeemable preference share. Optionally, this will be also compound financial instrument. Whenever optionally, it will be always compound financial instrument. Debentures convertible into fixed. Fixed at the option of the issuer. This will be classified as equity. Correct now. Now, in this question, nothing has been given about interest. Just try to understand. So, right now you need to find out the best option. So, they have given at the option of issuer. So, we'll assume that interest is also at the option of issuer because debenture convertible into fixed at the option of holder. It cannot be what? Equity. So, in this, the best option is what? Point number C, because the point number C is silent about interest. However, if it is fixed interest, this will also become compound financial instrument. Means it will not be equity in its entirety. But out of 4, you need to find a best option. Best option is point number C. Okay, sir. Come to question 31. Which of the following instruments are not an example of derivative contract? So it is total return swap, the LIBOR ring debentures, credit default swap, return treasury bond option. So can I say this? If you know AFM, means I think in the AFM you have done, you will do more detailed derivative. Correct. Now in FR we'll do accounting only to the extent from examination point of view about derivative, means we'll not do detailed discussion about derivative. So from, I think from AFM knowledge you will be able to understand total return swap, credit default swap. Whenever swap arrangement, that is nothing but derivative. Return bond, return treasury bond will be also derivative. So option number B is not what derivative, it is not an example of derivative. So I will say for this question 13.1 you need to apply thoda sa concept of AFM. AFM में you will deal with derivative more in detail about the theoretical part, I will say. चलेगा. Question 32. In respect of main bank debt factoring arrangement for its customer A, which of the following statement is correct? Continuing involvement asset must be recognized along with the associated liability. This is only correct. Means whenever there is a continuing involvement in the asset, then we recognize continuing involvement asset with the associated liability as per Ind AS 109. If you remember the concept about that continuing involvement in the liability in the financial asset transferred. Option number B, I think now there is no need to read, but option number A is only correct. Correct. Question 33. Global Limited has invested in debt oriented mutual fund. The investment should be similar question we have done. I have given the clarification also. It will be FBTP. This question has been repeated twice. Come to 34. For the equity investment in K Limited designated at FBTOC, the fair value gain or loss will be always recorded through equity and never be recycled in PL even when it is sold. Option number A is only correct because FBTOCI is always without recycling. For equity instrument, hybrid is debt instrument, it is with recycling. So option number A is correct. Okay sir, these are all theoretical questions. 35. The 3-year term loan obtained from a bank contain an option to extend the period of the loan at market rate prevailing at the date. State which of the following is correct. So similar, I think we have done one similar question with prepayment option has been given. So whenever the loan which is with a prepayment option, the option to extend the period, this type of embedded derivative will be always closely related with the post contract. In that case, the separation is not required. So it is an embedded derivative closely related to loan and therefore separation is not required. So option number B is correct. Let us read A. It is not, this is to not correct. It is an embedded derivative but not closely related. This is also not correct. It is an embedded derivative but not closely related to the loan, means this is also not correct. So option number B is only correct because that is closely related and therefore separation is not required. Question 36. A factory owned by ECL Limited was destroyed by fire. ECL Limited lodged an insurance claim for the value of factory building, plant and amount equal to 1 year net profit. During the year, number of meeting with a representative of the insurance company. Finally, before year end, it was decided that ECL Limited would receive a compensation for 90% of its claim. ECL Limited received a letter that a settlement check for the amount had been sent, but it was not received before year end. However, it is a question of Ind AS 37. By mistake, it came here. So just write down it is a question of Ind AS 37 related to contingent asset. You can see before year end, it was decided that ECL Limited would receive a compensation for 90% of its claim. ECL Limited received a letter that a statement check for that amount had been sent. Means now it is virtually certain. So whenever the inflow is virtually certain, it will be recognized as an asset in the financial statement. Means it is not a contingent asset. So what they have said, let's see. Record 90% of claim because they have said in the question he would receive a compensation for 90%. So record 90% claim as receivable as it is virtually certain that contingent asset will be received. So option number A is correct. It is a question of Ind AS 37. You can delete from here. By mistake it came here. Okay. Question 37 is a good question. I have taken this question from GFRS. I don't know whether this type of question will be asked, but this is from ICA resource only. ABC Limited present equity shareholding structure is given below. Class A equity shares and Class B equity shares. Of rupees 100 each, of rupees 100 each. So you can see his shareholders name is AB, who hold how much Class A equity shares? That is how much? It is 90. Is how much? 9 crore. 9 crore. And this become 1 crore. So this become 10 crore na? 10 crore. Similarly, they have given for class B equity shares also. CD is a private equity. CD, so CD is this company, is a private equity investor that infused rupees 1000 crore in ABC Limited Class A shares rupees 400 crore and Class B equity shares rupees 600 crore. Okay, correct. On 31st March 2011, at a valuation of rupees 8000 crore on a fully diluted basis, ABC Limited has entered into a shareholders agreement with the shareholders as per which the terms of Class A and Class B equity shares are as under. Class A equity shareholders are entitled to dividend at the discretion of board of directors. Okay, Class A equity shareholders will be equity instrument because the dividend is discretion at the discretion. Class B equity shareholders are entitled to fixed non-cumulative dividend of 10% subject to availability of profit in the year and distributable cash as on the balance sheet date of the relevant year. The profit of ABC Limited are to be determined as per the statutory financial statement of ABC Limited. Distributable cash is defined as free cash and cash equivalent available with the issuer. In this case, dividend is contingent, and whenever dividend is contingent, it will be classified as financial liability. So in this case, the Class B equity shares will become a compound financial instrument. I hope you are understanding. The projector of the projection of profit or loss and the balance of ABC Limited for the 10 years subsequent to the private equity investment as estimated on the date of such investment are as below. So they have given for projection of the projection of 10 year they have given from 2012 to 2021, means future projection has been given. Opening cash and cash equivalent, profit or loss as per financial statement, depreciation, impact on profit or loss due to IFRS conversion. Each Class B equity shares is convertible into Class A equity shares at the end of 10 years. So Class B is convertible into Class A from date of infusion of fund by CD Limited. But dividend is what? Dividend is contingent, therefore it will be classified as what? Compound. Dividend of 13% is paid for the similar instrument in the industry. So this become market rate of interest. What will be the classification of Class A? Because such a big question, but they have asked only classification. So I will say if the same question comes, you should, without reading, you can do it. Class A, it become what? Equity. So Class A will be equity. So option number D is correct. And Class B will be compound financial instrument. So option number D is correct. Very easy. Now they have asked what will be the journal entry including the amount thereof to be passed in respect of initial recognition and measurement of Class A equity shares. Very easy. It is bank account debit to equity, bank account debit to equity, and you can see the Class A, what was the amount they have invested, 400 crore. So it will be bank account debit to equity. So option number A is correct. Very easy. Correct. But can I say in Class B, what is the journal entry? It will be bank account debit to financial liability to equity instrument. So you can see option number A is wrong, option number B is wrong, option number D is wrong. So option number C is only correct. Without calculation you can do, so option number C will be correct because it will be bank account debit to financial liability to equity component. So this is only correct. Now if you want to know how it has been calculated, I can inform you, but if this option has been given without calculation, you can say option number C is correct. Got this point, whatever I'm saying. Now let's see how it has been calculated. So what they have said, the dividend will be lower of what, means what they have said, if you see the dividend is subject to, means if you read the point once again, the Class B equity shareholders are entitled to fixed non-cumulative dividend of 10%. So 10%. So 10% of what amount? It will come how much? 10%. So dividend, the dividend at a rate of 10% of what amount? Amount is what, Ray? Class B. So Class B is what this? Yes or no? Okay. Of rupees 100, I think they have calculated per, what they have calculated is 100. Okay, sir. But chodo, I'm explaining. What is the, they are saying it is subject to, opening cash and cash equivalent and profit. So this is opening cash and cash equivalent and this is the profit. These two information are not relevant. These two information are relevant. It is subject to opening cash and cash equivalent and profit. It means, can I say we need to compare dividend, opening cash and cash equivalent and profit. Whichever lower become what? Dividend. Whichever lower it become dividend. So you can see they have given opening cash and cash equivalent EA, if you can write down. Then profit as per previous gap you can write down. And these two information not relevant. Dividend at the rate of 10%. Dividend at the rate of 10%. So 10% they have calculated. I think they have calculated on which amount? This figure is in crore. So figure is in crore. So of this amount they have calculated. Correct now. So dividend will be on this percentage of total class B, that is coming what? 100 crore. So you will take lower one. So you can see 100 minus 20, 100. Lower is what? Nil. Here also it will come nil, 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 nil. And in this case you can see 8, 10 and 100. Lower is 8. It will come 8. Then 26, 13, 100. It is coming 13. Then it is coming 18. Then 23. Then 25. Now you can find out the present value by using 13% market rate of interest. It will come. The present value will come. That will become what? Liability component. To liability component you can find out. The liability component will be 31.2. So 600 minus this will be what? 600 minus this will be equity component. So in this way you can calculate. In this way you can calculate. Got this point? So I will say the calculation was not required, but then also you can do it. Okay sir. So I will say थोड़ा सा अटपटा question, but then also I have taken this question from GFRS Medri. If suppose this question asked, you should be able to do it. Okay sir. 38. A Limited has invested in debenture whose interest rate is floating in nature, and as per the terms of instrument, interest will be reset every month. The terms of interest is 0.5 multiplied by MIBOR plus 2%. Classify the financial asset and determine the subsequent measurement for the aforesaid instrument. So can I say, even though interest rate is floating, it will be carried at amortized cost only. So it will be measured at amortized cost. So financial asset will be measured at amortized cost because it represents what? Contractual cash flow characteristics, and of course if nothing is given, it will be hold till maturity. Chalega. Coming to question 39, which of the following category of financial asset is not subject to impairment review? So impairment review, there are two exceptions which is not covered under the scope of impairment. One is equity instrument measured at FBTOCI and financial asset measured at FBTPL. These are not covered for impairment wala topic. So equity instrument measured at FBTPL, option number 1 is only correct. So option number 1 will be correct. Lease receivable is covered, trade receivable is covered, and investment debenture where means which is measured amortized cost will be also covered. Means that instrument are covered. Got this point? That instrument which are FBTPL will not be covered. Okay sir. Question 40. New Age Technology Limited has taken a loan from the bank which has a debt to equity ratio as one of the financial covenant. Any new fund could have a direct implication on the covenant of existing loan. Therefore, CFO want to understand which among the following instrument is the equity instrument. We need to find out which one is equity. So non-redeemable preference shares with the payment of dividend at market rate. This is a compound financial instrument where it is understood payment of dividend. So dividend is not discretionary. Preference share redeemable at the option of issuer with payment dividend as per discretion of issuer. This is at the option of issuer. Both this become equity instrument. Option number 2 is only correct. Preference share redeemable at the option of holder, not. Preference share redeemable at the option of holder. This is also not. So option number 2 is only correct. Come to question 41. On 1st Jan 2006, XYZ may issue a new instrument with the following characteristics. Face value 100 and issue price 90. Cumulative dividend payable at 5% per annum for 10 years. After 10 years, the dividend is payable at a discretion of the issue. But after 10 years, dividend is as discretion. But before 10 years, it is not discretionary. The holder of this note has an option to convert the ordinary shares of XYZ Limited after 10 years. So holder has an option to convert these shares, convert into ordinary shares. And the conversion will be 10 ordinary shares for each instrument. So that has an option. Option means why it will be classified as financial liability only, but option has been given. The holder can demand redemption of the face value at any time within 6 month notice up until the end of 10 years. After 10 year redemption is at the discretion of the issuer. So after 10 years the redemption is discretionary. There is no fixed maturity date. how should the instrument be classified by XYZ Limited in the first 10 year? In the first 10 year, can I say it is a compound financial instrument? So it is a compound financial instrument. Option number 4 is correct. Chalega. Come to 42. Entity A has issued preference share to the investor which has a similar voting right and dividend right and will be converted into 1:1 equity shares at the time of IPO. As per terms of agreement, if the IPO does not happen by the end of 7th year, the company will have to buy back the shares from the investor. The company is growing very fast and is confident of going through the IPO within 3 years itself. How will the company classify the above instrument in the financial statement? What they have said? Entity has issued preference share to the investor. Entity has issued preference share to the investor which has similar voting and dividend right and will be converted into 1:1 equity shares at the time of IPO. At the time of IPO, it will be converted into equity shares. Means the dividend is discretionary because they have said entity has issued preference shares to the investor which has similar voting right and dividend right. So similar voting and dividend right as per what? Equity shares. As per terms of agreement, if the IPO does not happen by the end of 7th year, the company will have to buy back the shares from the investor. Means there is an obligation to repay. The company is growing very fast and is confident of going through the IPO within 3 years itself. But can it become contingent? Because if the IPO does not happen, then there is an obligation to pay. The principal amount will be initially classified as financial liability. Or the company classify the above instrument, so it will be compound financial instrument only. It will be classified as compound financial instrument. I think done. Okay, sir. So entire point, all the MCQs have been covered. I hope whatever we have discussed, this will definitely help you. If you have understood everything, just leave a message in the comment box how you have liked this video. Don't forget to share this video with your friend. Okay, and all the best for your preparation. I hope these MCQs are benefiting you and this will help you to get 30 out of 30 in exam. Bye bye, all the best till then.